Hey everybody, welcome back to the channel. Just wanted to upload another video. I'm getting a lot of questions on a couple of different arrangements for temporary staffing services, and I just wanted to add some clarity. Add a quick video. I don't really like doing a long video because basically there are a lot of different topics that we want to cover, and I want you to be able to click on the appropriate topic, get the information, and be on with your day. So real quick, just wanted to touch on a few things as far as work comp arrangements and what temporary staffing services get offered traditionally. So there's your traditional work comp model where you have your rate for whatever job classification that you have. It's applied to the gross annual payroll. Now, when you set up the policy, you will set up the policy based on an estimate. Then you will have an audit at the end of the policy term. Some policies are monthly self-audit, and then your payments will be based on whatever you report. But let's just look at a traditional work comp policy for now. That is based off of your estimates. So those work comp policies are sometimes single states, or they will be multiple states, depending on the insurer and where they're licensed. So when you're setting up a new venture, a lot of times you just have the state fund for that state. It will be the only voluntary or only traditional market that will be available to a new venture staffing firm for two reasons. One, because of the years in business, most voluntary markets that volunteer to insure companies through their underwriting plans will be 3 years minimum in business, and we have minimum premium. So they want you to hit at least a minimum threshold for premium to be able to qualify for their programs as well. So if you don't meet those two criterias, you only have the state plans, which will be NCCI or a state fund that's ran by that state. Let's say North Carolina, New Jersey, New York, Florida, California. Those are a couple of the state funds that are only for that state. Some of the NCCI states will play well with each other, be it like Tennessee and Georgia. You can put those two on the same policy. So I don't want to get in the weeds about that. We can have a further discussion specifically about what your needs are, but just wanted to hit on that as far as the topic. So those are the traditional work comp plans where you project annualized payroll in which classifications and which states. We put it on our application, we send it out, we get approval, you bind coverage, and you'll pay 15 to 25% down and then monthly installments. If you don't meet a minimum threshold there, you may have to pay the premium all up front based on your estimate. That's why we like to keep the original estimates a little bit low, because number one, you don't have payroll, and then two, you don't want to over project, lock yourself into a high payment that's unnecessary that you don't have the revenue for. We're here to help you and assist you to be in business, not put you out of business with insurance premium installments. So those are the traditional plans. On top of that, we have a couple of other options that are in the marketplace as well. One is going to be a PEO, or a professional employment organization. They specialize and are licensed in every state, or have the ability to be licensed in every state. Not all of them are, but they will operate in your state, and they will submit your taxes for you. They will handle any employment related practices issues. They are basically your back office HR department, but they are a co-employer. So that's a little bit different than being the true employer of record, which we'll get into next. But the professional employer organization is a co-employer where they share the responsibility, but you are also being endorsed onto their policy as well. So both names will show up. If you search the Department of Insurance and try to look for coverage, your name will also show up because you're a true co-employer. You're splitting those obligations truly with them. And again, it's through a license scenario where those people are a professional employer. So they handle all of your back office HR compliance. They will administer benefits, a lot of stuff that like a Paychex or ADP will do, but they also roll in the work comp piece of it. So you'll be charged, and I go into this about your payroll burden, but you'll be charged that burden where you see your FICA, FUTA, SUTA taxes, your work comp, and then any administrative costs that they're charging you to actually run your payroll. So that's a PEO in a nutshell. They are a co-employer. Now, the last one I want to hit on is the true employer of record model, or an EOR. Now, you may hear about this one. This is de facto a staffing company in itself. This company's been set aside, and they will take your employees, run them through their company. You become just a marketing arm for that company, but your employees are 100% ran through their federal ID number. They are, per the name, the employer of record. So they handle 100% of everything. They are responsible for the general liability, professional liability. They are on the benefits requirements for the Affordable Care Act. They will be responsible for any tax payments. They are on the hook, though, 100%. So there's no co-employment there. There's no endorsement for your company. They are just the true employer of record that's handling everything. You are basically, you can manage those employees. You'll do the employer paperwork as far as getting them onboarded. You will be billed in a similar fashion to like a PEO, where you are billed. Let's say you turn in your hours on a Monday, you'll get an invoice on Tuesday or Wednesday. You pay that invoice, and then your employees get paid that Friday. So the billing sort of works the same on an EOR. An EOR can offer within its bundle a couple other things too. Like I say, the general liability comes along with it because they're 100% the employer. They have to provide the liability piece of it. So if something happens, they're on the general liability piece, whereas a PEO, you're still operating as your company as a co-employer, so you need to have your own general liability. On a EOR, I still recommend that you get your own small policy because your company can still be sued, but also the liability for those employees is 100% on the employer of record versus it being a shared responsibility. So but you actually pay for the services as needed. With an EOR, what I was getting into is that you can actually layer in some funding with that as well. Some companies offer funding as part of their services, or some people have a preferred vendor. I like the preferred vendor model because those relationships can change, and I don't want to put that in with any of our products we offer, just because, again, what works for some may not work for others, or what interest rates hot today may not be the best for later. So I want that to be interchangeable. We have vendors that we can refer you to. But when I talk to someone as a new venture, or even an existing staffing company, what states are you operating in? What industry are you servicing? Those two questions right there can tell me exactly which model would be best. I can recommend which one's best, but I want to tell you about all of them, have you make an informed decision. So I just want to do a quick video, explain the differences here. Feel free to ask questions in the comments box, or call me at any time. My number is 865-963-1224. I'm available to you guys. You can text that number, call me. I'm here to help. I want you to be successful. Have a wonderful, blessed day. Thank you so much.